Hi, good afternoon, everyone. I'm Christophe. I'll be your host today, and we're still gonna wait a little bit because we have more participants that should be joining. Okay, I think we can start. Maybe some more people will join in the course of the presentation. So, good afternoon, everyone, and welcome to our webinar for China tax transfer pricing, risk compliance, and planning. As businesses navigate an increasingly complex international regulatory landscape, staying ahead of tax compliance while maintaining commercial and operational efficiencies can be quite complicated for some leadership. So today we'll dive deep into the TP, how it works in China, and the potential traps company can encounter during their life cycle, and proactive measures to mitigate the risk. Before diving into these technicalities of transfer pricing, let me maybe briefly introduce who we are at Acclaim. And by the way, I'll be your host, Christophe, and my colleague, Andrea, will be our expert speaking in a minute. So at Acclaim, we are a leading corporate service firm and advisory with more than 30 offices across 20 markets. We are mostly based in APAC and the Middle East. Our main role is to support enterprises with their corporate tasks, such as company formation, corporate secretary, accounting, tax, payroll, but we also provide advisory supports, such as transfer pricing, advisory, benchmarks, but also tax due diligence, financial due diligence, valuation, audit, as well as supply chain and ERP implementation. Our support is meant to address any stage of a company's life cycle, from market entry to, unfortunately, some exit, especially in the past few years, but now recovering gradually the FDI in China. So as you can see from this map, we have quite a large footprint, of course, throughout Asia, but basically internationally. And we manage corporate compliance for a lot of foreign invested companies, and we address on a daily basis their intra-group cross-border transactions. So we see firsthand the importance of having properly structured transfer pricing policies for our clients to avoid damaging their hard-earned profits and sometimes even their reputation. That's also talking about the infamous arm's length principle in transfer pricing. Anyway, I'm not going to spoil the presentation from our specialist, Andrea. Andrea, I'm thrilled to introduce you to our webinar and our participants. You are our tax director at Acclaim China and bring a lot of deep corporate and advisory experience, having previously managed tax and treasury at Mead Johnson in Greater China, but also worked as a tax officer in your earlier professional adventures and also understanding the mechanism behind the scene. So being both a certified accountant, but also a tax agent, he specialized, of course, in TP policy design, documentation preparation, but crucially, and very importantly, communicating and negotiating with the tax authorities on behalf of our clients. So you bring a lot of practical insights into navigating TP in China nowadays. A quick word about myself, Christophe. I'm a director at Acclaim. I've been in China since 2002. That's close to 25 years. Been advising SMEs and MNCs for as long as I've been in China with their market entry, structuring, regulatory compliance, also corporate taxation challenges. And we, over the past few years, I've seen a lot of, shift in this tax with the tax authorities, and more importantly, with the intercompany transaction and a sharp increase in tax audit and unfortunately, sometimes some fines. So we're dedicating this entire 1 hour session to transfer pricing. Why? It comes down to basically 4 pillars. Aggressive scrutiny from the tax bureau, moving towards strict enforcement, backed up by massive big data capabilities, but also dedicated TP audit teams that have been enforcing never than before, enforcement about the about the transfer pricing policy. And then forever adjustment means underpayment of tax liabilities, steep interest charges, but also penalties. So that can also affect the reputation of the company, something to be careful about is because in China, with the adjustment are being increasingly made public through official announcement, but also case studies to educate the wider market. So no firms wants to have their name in the front page of the tax bureau to be a poster child for non-compliance. But it also brings some opportunities. On the flip side, TP planning is just not about avoiding the audit. It also allows your business to safely utilize tax treaties, also using established APAs, advanced pricing arrangements, and legitimately optimizing the global tax burden by allocating profit where the real economic substance and value creation happen. So to give you a roadmap of today's session, so you know what we'll be talking about, and we have just about an hour, so we'll wait and open the floor to the Q&A at the end. The TP Foundation, looking at the legal framework, the arm's length principle, of course, the key tax bureau announcement that you need to know, but also covering the life cycle to identify common traps in contract management, pricing inconsistencies, and filing anomalies that can trigger some audit. But also we'll cover the proactive measures, discussing how to design defensive pricing models, handle intercompany financing, and utilize the tools like the APA, unilateral, bilateral, or even multilateral. And we'll wrap up with the key takeaways, a few tips and maybe action that you could be taking soon, and your Q&A. So let's start with the foundation. Andrea, the floor is yours.
Thanks, Chris, for the opening up. Hello, everyone. I'm going to spend the next 30 minutes to walk you through for a high-level introduction of transfer pricing in China. So now let's start from the legal foundation of transfer pricing. You don't need to memorize article numbers, but you do need to understand the single most important concept that drives every TP rule, every audit, and every penalty in this country. That concept is the arm's length principle. Then what is the arm's length principle? In simple terms, related parties must transact with each other as if they were unrelated parties under the same or similar circumstances. Imagine you have two separate independent companies. Company A in China sells a product to Company B in Germany. They negotiate the price. If Company B can get a lower price from another supplier, it will. If Company A can get a higher price from another buyer, it will. So the final price is determined by market force, not by ownership. That's an arm's length transaction. Now, if Company A and Company B are related, they could, in theory, set up any price they want. They could charge very little to shift profit outside of China. The arm's length principle says, no, you cannot do that. You must follow my rule. Otherwise, Chinese tax authority will make TP adjustment. Okay, next. Now, let's talk about the 4 written regulations that actually put that principle into practice. Announcement 42 of 2016 was a game changer. Before 2016, China had a much simpler one-tier documentation system. Announcement 42 brought China into alignment with the OECD BEPS Action 13 report recommendations, despite China not being an OECD member. Announcement 42 introduces a 3-tiered documentation structure, including local file, master file, country-by-country report, which I will introduce later. Then there's Announcement 6. There are 4 key things you need to understand about Announcement 6. First, it codifies the TP audit process. Second, it lists specific red flags that trigger tax authority attention. And third, it introduces special rules for intangible assets and services. Fourth, it covers advanced pricing arrangements, we call it APA, which bring us to a slight clarification. Announcement 14 of 2018 is about MAP. But what is MAP? Why does it exist? Even with the best TP documentation, disagreements can arise. A Chinese tax authority might make a TP adjustment, but the related party's tax authority might disagree. So this can result in double taxation. The MAP is the formal dispute resolution mechanism under bilateral tax treaties. It allows the tax treaties. It allows the tax authorities of the two countries to negotiate a settlement to eliminate double taxation. Announcement 35 of 2024 is the most recent addition to China's TP framework. It represents a significant shift in how China monitors related party transactions. The key theme of this announcement is from reactive audit to proactive monitoring. It enhances the tax authorities' ability to monitor TP risks through the golden tax system pool. Okay, next. Okay, before you can apply any TP rule, you must answer one threshold question. Are the two parties related under Chinese tax law? If the answer is no, then transfer pricing rules do not apply at all. If the answer is yes, then everything we discussed today applies. Documentation, risk of adjustment, potential penalties, and so on. The definition of related party is broad. The core concept is control. Two parties are related if one party has control over the other, or if a third party has control over both of them. The first and most common test is shareholding. Directly or indirectly holding 25% or more of the voting shares give rise to a related party relationship. But equity is not the only way to control a company. You can also control through appointment power over the board of directors or senior management. On top of that, there are other situations that create a related party relationship. For example, loan dependency. If one party is borrowing from the other parties exceeds 50% of the borrower's total paid-in capital, they are related. And there's also guarantee dependency. If the one party is borrowing from a third party is guaranteed by the other party, they are related. Then there's the IP or technology dependency. If one party's business operations depend on IP provided by the other party and the IP provider has the right to control the user's operations, they are related. And finally, there is a catch-all provision. Two parties are related if their relationship through any means, contracts, family ties, or other arrangements result in one party have control over the other. They are related. Okay, next. Then how do you actually determine whether a price or a profit is arm's length? Chinese tax law recognizes 5 transfer pricing methods. The first method is comparable uncontrolled price. We call it COP. COP is the most direct and, in theory, the most reliable method. It compared the price charged in a related party transaction to the price charged in a comparable transaction between independent parties under the same or similar circumstances. COP works well for commodities or financial transactions. However, true comparability is difficult to achieve. So therefore, Chinese tax authorities use COP less frequently than you might expect. Then there's resale price method. The resale price method is used when a related party buys goods and then sells them to independent customers without adding substantial value. For example, a distribution company. It starts with the resale price to an independent customer, then subtract an appropriate gross profit margin that independent distributors earn on similar products. Then what remains is the arm's length price that the distributor should have paid to the related parties. Next is the cost plus method. The cost plus method is typically used for contract manufacturing or routine intra-group services. This method calculates the total direct costs incurred by the supplier in producing the goods or providing the services, then add an arm's length markup. Then there's the transactional net margin method, we call it TNMM. TNMM examines the net profit margin relative to an appropriate business, such as sales, costs, or assets that a taxpayer realized from third-party transactions. That margin is compared to the net profit margins achieved by independent companies performing similar functions and bearing similar risks. TNMM is very, very popular in China. Tax authorities, most of the cases closed with the TNMM method. Then the last one is profit split method. The profit split method is used when the related party transactions are so highly integrated that separate pricing for each transaction is not possible, or when both parties contribute unique and valuable intangibles. Instead of looking at individual prices or margins, for the profit split method, you determine the combined profit from the controlled transactions, then split that profit between the related parties. There's a practical point. You are not required to use only one method. You should select the method that provides the most reliable arm's length estimate given the facts. And if the tax authority disagrees with your choice, they can impose their own method. They always use TNMM. Okay, next. Okay. The next practical question is, what do you actually need to prepare and file? China follows the OECD style three-tiered documentation structure. This is not optional. If you meet certain thresholds, you must prepare these documents. The master file provides a high-level overview of the entire multinational group's global business. It is intended to help the tax authority understand the group's transparency policy in a broad context. At minimum, the master file must include organizational structure, description of the group's business, intangible assets, intercompany financial activities, financial and tax position. You must prepare a master file if your group is required to prepare a master file in another country under OECD BEPS, or your group's annual related party transactions exceed 1 billion RMB. The master file must be prepared within 12 months of the ultimate holding company's fiscal year end. In practice, Chinese tax authority usually requires the master file to be submitted upon request. And the local file is the most important document for Chinese entity. It focuses on the Chinese entity and its related party transactions. When the Chinese tax authority audit you, the first thing they will ask is the local file. The local file is required to contain the company overview, functional analysis, description of a related party transaction, comparability analysis, benchmark study. The local file is required if your Chinese entity in a single tax year exceeds any one of the following thresholds for the related party transactions. For tangible asset transfer, including both purchase and sale, exceed 200 million RMB. For financial asset transfer, exceed 100 million RMB. For intangible asset transfer, also 100 million RMB. For other transactions, such as services, royalties, interest, exceed 40 million RMB. The local file must be completed by June 30 of the following tax year. If you are required to have a local file but do not prepare one or prepare it late, you are facing a penalty. Then there's a country-by-country report. The country-by-country report provides high-level data on revenue, profit, income tax, capital accumulated earnings, number of employees, and the tangible assets per jurisdiction. A country-by-country report must be submitted to the Chinese tax authority if the ultimate holding company of the group is a resident in China, and the group's consolidated revenue in previous fiscal year exceed 5.5 billion RMB, or the group meets the threshold, and the ultimate holding company's country does not have a country-by-country exchange agreement with China. The country-by-country report should be submitted together with the annual tax filing by end of May in the following year. Okay, next. Okay, next slide, please. Separate from the three-tiered documentation, a company engaged in any related party transactions, regardless of size, must complete and file report on related party transaction. Also, we call it Form 42 as a part of the annual corporate income tax filings. So that's about the documentation. Okay, next. Now let's turn to the real-world risks. Next slide, please. Now, let's start with the very first stage of any related party transaction, contract management. I believe most group has written contract for the related party transactions, but having a contract is not enough. So I would like to walk you through three common contract management risks. For example, in the service contract, sometimes the description of the service scope is very general. When tax authorities see the contract, they will ask, what have been done? What's the deliverable? How Chinese entity is benefit from the service? So in that case, the company will be in trouble. And also, another example is in the royalty payment contract or license fee contract. The information in the contract sometimes is not consistent with the reality. For example, in the contract, it says all the IPs belongs to the parent company, but in reality, actually, Chinese entity owns some of the IP because the Chinese entity would like to enjoy the high-tech company benefit. In that case, the Chinese tax authority will ask, since Chinese entity has its own IP, why? Or is it necessary for Chinese entity to pay royalty to oversee related parties? And also, there's another risk that is disclose too much information in the contract. You may say, more information is better. It shows that we are transparent, but from transparency perspective, it's very dangerous. More information is disclosed, more questions will be asked. Sometimes, some companies will just disclose their internal forecast, target, or policies in the contract. So that's something that I would like to remind you to really be careful about that. And next. Okay, now it's about pricing risk. Pricing risk is the most direct risks. It's also a trigger that could cause a transparency audit. The first risk is, setting prices inconsistently with the arm's length range. This risk is caused because most of the time, a company set up the price without a benchmark analysis. They just, set up as they wish, and then they find out actually their price is not in the range of the arm's length principle, not in the range of arm's length range. And the second risk is that the pricing policies do not match the actual function assets and the risks profiles. Function asset, the risks is very important concept in transfer pricing area. And so usually when the company set up a price, they should conduct a functional analysis. But sometimes even they have conducted such kind of analysis, they never review it, for years, but everything changed. So actually this will cause risks. And the third risk is that a limited risk entity is in the loss position. Limited risk entity means entity only performs very simple, very routine activities. Such kind of entity is expected to maintain even low but stable profit. So if it's in a loss position, it's actually not allowed based on China tax laws. So the Chinese tax authority will ask the company to prepare a local fare immediately, no matter how much is the related party transactions amount, to explain, whether there's any special reason to cause the loss. And if they don't accept the position, then they will just make TP adjustment. Then there's risk for intergroup services. If a Chinese entity is the one who receiving services, they must pass the benefit test. That is how Chinese entity is benefit from the service. Otherwise, the cost will not be allowed to be deducted before the corporate income tax. And if the Chinese entity is providing service, the Chinese tax authority will always challenge whether the markup is high enough, especially for those high value service, such as R&D service, technical service. Then the last risk is about intangible asset. No matter whether it's about intangible asset transfer or intangible asset usage. Usually the risk is about the royalty rate is not reasonable, maybe it's too high, it's flat for years, or because the cost contribution, because both sides have contributed to the intangible assets, but the Chinese entity is not compensated by their contribution. So that could be one of the risks. Okay, next. Okay, now there's a risk in filing and reporting. This kind of risk actually is totally preventable, but unfortunately, every year it causes a lot of problems. Sometimes there are mistakes or errors in the filing and the documents, or the information in the filing and the document is incomplete. Or the information in the filing and the document is not consistent with each other. In such kind of a situation, the tax authority will either reject the filing and the documentation, or they will just it will just cause their attention. Just you lose your credibility. The tax authority will think that either the filing and the document is not reliable, or actually the company did not follow the TP rule as they said. And sometimes we also see that the companies actually they did not quite understand Chinese tax laws, and they have no awareness about the threshold for local file. Then suddenly one day they receive a notice from the tax authority for submission. They just prepare the local file, prepare the documents in a hurry. So you can imagine in that case, there's no guarantee for the quality of the document. Okay, next slide. Oh, now let's look at the other side on the table. How Chinese tax authority identify the target? What kind of adjustment they could make, and how far they could go back for the audit? The Chinese tax authority will not just screen the target manually. Actually, they use a very advanced big data risk selection system, and the system will just analyze every corporate tax returns, and it flags companies with certain characteristics. For example, for those companies that with long-term losses or with low profit, I mean lower than the average profit, and it will be flagged. Or for those companies with large royalties or services, paid to the related parties that are based in low tax area, in that case, the system will flag them. And if the risk score of a company is high enough, then manual review will be involved. And the manual review always leads to official transfer pricing audit. So really be careful. And if there's a TP audit, there are three types of TP adjustment. The first one, also the most important one, is primary adjustment. Primary adjustment means the Chinese tax authority will just adjust the price benchmarked with the independent parties and adjust the profits before tax that the Chinese entity then need to pay additional tax. Then there's a secondary adjustment. Secondary adjustment means the Chinese tax authority Chinese tax authority just treat those excess profit, those unreasonable profit generated by the parent company. They treat it as dividend distribution, so they will just levy withholding tax for it. But secondary adjustment is not that kind of common. In some real aggressive TP audit, Chinese tax authority have right to do that. And the third one is corresponding adjustment. Corresponding adjustment is not made by Chinese tax authority. It's made by the related party tax authority. Because when there's a TP audit made by Chinese tax authority, the profit Chinese the profit Chinese entity is make is higher. The profit the tax they paid is higher. Then that means that actually the related party should make less profit, should pay less tax, and they should receive tax refund from their tax authority. But unfortunately, a corresponding adjustment is not made automatically. If you want to achieve it, you must apply MAP, what we have introduced just now. And the statute of limitation, usually in China, the statute of limitation for tax audit is 3 to 5 years. But for transfer pricing, but for TP audit, the cover year is 10 years. So don't assume that there's no tax audits for years for your company means your company is safe. If the company has a very aggressive TP position years ago, it will just come back one day that will hurt the company. And recent audit trend based on the recent audit cases that the Chinese tax authorities, they shift their focus. When I was working in a tax authority, we usually will focus on the tangible assets transfer. But now tax authority just focus on services, intangibles, or financing arrangements. Okay. Next slide, please. Okay, now let's turn to the positive way. What you can do from next week to manage the transfer pricing risk and even to optimize the TP, tax efficient with a proper TP arrangement. The first one is to prepare a robust and real-time TP documentation. Just now, I introduced the thresholds for local file, but the threshold is just for submission. It's not a threshold for audit. We see more and more cases, even the companies did not reach the threshold for local file. Their tax authorities ask them to provide the local files, especially in this year. So prepare for those companies who really care about their transfer pricing matters to prepare local files in advance before they reach the threshold will always help, and it will help the company to regularly to review their TP position and to build up the habits to collect supporting documents and to build their documentation system. And also, we would like to suggest companies to perform benchmark study when they set up the price, and also to update the benchmark study every year, ideally. If it's not possible, at least every 2 or 3 years, with the most reliable database. And we also, suggest those companies receive service payments to make a service payment to make the benefit test and also to collect supporting documents to support for the benefit tax. For example, the purchase order for the service request, the meeting minutes, the working paper, timesheet to justify what kind of service has been provided, how Chinese entity is benefited from those activities. And also we suggest a company, whenever there's any big change, for example, if a Chinese entity start to perform R&D activities or start to add distribution activities, whenever there's a big change in their business model, they should conduct a functional analysis to match their TP position. Okay, next slide, please. Okay, we also suggest the companies to design a defensible pricing policies. First, the pricing policy should be aligned with the functional profile. Most of the companies, they make the same mistakes. They start with a desired profit level. Say, we would like the Chinese entity to achieve 5% profit, then they force the functional analysis to fit that number. But that's backward. The correct order should be that, to decide what the Chinese entity is going to do, what kind of a function is going to perform, and what assets is going to use, what kind of a risk is going to take. And then, and only then, to benchmark, the independent parties with a similar function, assets, risks, and then to decide what kind of a price is a reasonable price. And also, we suggest the company to have a regular review of the financial results and to close the gap timely. Some of the company, they just set up the price at the beginning of the year, but they never review it. Then after the year-end closing, they suddenly realized actually the fiscal results are, just for outside of the range of the arm's range, but nothing could be done. So we suggested the company to, at least to have a quarterly review of the financial results. And also, we suggest companies to avoid to use one-fits-all markup for all transactions. Because different transactions, different transactions has different risk profile and has different, method or way of value contribution. If you use one flat markup for every transactions, you are either, undercharge for some high value activities or overcharge for some routine activities. And we also suggest having a detailed group TP policy in place. A group TP policy is not a required legal document in China, but it will be a plus, especially when there is a TP audit. Usually in the in the group TP policy, it will just describe the functional profile of each entity, their TP position, and the transfer pricing method the group is used, and the process of the adjustment. And it will help the company to leave a very good impression to the tax authority that this company is they have a very good management over their transfer pricing matters, and this will also help the group to centrally manage their transfer pricing matters to ensure that the transfer pricing implementation is consistent between entities. And also it will help the local finance team and the tax team to understand what they are expected to do. Okay, next slide, please. Okay, you can also use APA. APA is Advanced Pricing Arrangements. It's a bonded agreement between a taxpayer and the tax authorities to cover to cover kind of related party transactions in the following 3 to 5 years. They just negotiate a price or profit for that period. If there's APA, the tax authority will not conduct a transfer pricing audit for the covered related party transaction in the covered period. So there are 3 types of APA. The first one is unilateral APA. Unilateral APA is the agreement between a taxpayer and the Chinese tax authority. The advantage is it's very quickly to for sale off. But the disadvantage is because only Chinese tax authority is bonded, so it could not eliminate the double taxation. Then there's a bilateral APA. Bilateral APA is good to eliminate double taxation because this is agreement between Chinese tax authority and the related parties tax authority. But it will take a longer time to reach a deal. Then there's a multilateral APA. Multilateral APA is agreement involve above three countries' tax authority. The process is very complicated, and it will take very long time to reach annual settlement. And usually, it will just apply to those big group. Okay, next slide, please. Now let's turn to the 2 areas that cause the challenges from tax authorities more and more. The first one is intercompany loan. For intercompany loan, please always pay attention to the interest. Usually, the interest should be benchmarked with the interest of the People's Bank of China, and yeah, they usually you need to take reference of the loan prime rate from the People's Bank of China, and then add a credit risk spread. And also, please pay attention to the thin capital rule. Thin capital rule means for non-financial companies, the debt to equity ratio should not exceed 2. And for the financial companies, the ratio should not exceed 5. Otherwise, the excess interest will not be allowed for deduction. For the intangible assets, we will suggest that it's better to register the IP. Register IP is more easy to to be defensible than non-registered know-how. And if there's an intangible asset transfer, Chinese tax authority will always ask for an appraisal report, which is issued by qualified valuer. And if there's a cost contribution arrangement within the group, please remember to allocate the cost based on a very clear objective allocation key. And also don't forget to apply dumping analysis. A dumping analysis is the analysis about the activities of development, enhancement, maintenance, protection, and exploitation. It will analyze how much each entity contribute to the intangible asset. And it's the base to decide how to split the profit between entities. So especially if there's a transparency audit for intangible assets, the recent trend is the Chinese tax authority always asks for a dumping analysis from the company. Okay, next slide, please. Okay, last, if there's opportunities that you can use, you can just to try to reduce the legal tax burden of the whole group. That is use the transfer pricing planning. Okay, the TP planning doesn't mean to hide a profit. Actually, it's about how to allocate proper profit to entities with proper functions, and to design the function and asset first. And if you want an entity based in a low tax area to generate more profit, you need to to design its function first. And also don't forget the tax treaties. You can leverage tax treaties to reduce the withholding tax for dividend, interest, and royalty payment. But please remember, don't use just a share company to do the benefit shopping. That will be very dangerous, and it's not allowed in China. And you must if you want to enjoy tax treaty, you must have a supporting document to prove there is a business substance. Okay, so that's all for my part. I will just give the floor back to Chris. Thank you.
Thanks a lot, Andrea, for this insightful TP tour. I'm sure I will give back the floor to you with the Q&A in a moment. So before we transition also to some key actions, which were already previously mentioned by Andrea, let's review the key takeaways. Document as early as possible, consistently, but also tidily. Not to forget the tidily, because we see a lot of companies when they have audit, they can't remember where is the last version of the document on a SharePoint at the head office or locally. So do not treat the transfer pricing as an end of your administrative burden, and do not wait for the audit notification letter as well. But this is an ongoing exercise, which is also your strongest armor or defense. We say data defense. It's all about data. Align the pricing with the commercial facts, your contractual setup, invoice flows, local operating margin must strictly match with the realities of your FAR, function, asset, and risk profile. Verified, that's important, against an independent market comparable. How you do that? This is through benchmarking. Benchmarking is indeed important to do this every 2-3 years. We have clients that ask us to do this on a regular basis to make sure they're aligned in China, they're aligned at the group level, and they are not bothered with, say, a tax audit that should not have happened in the first place or should have been shorter than what it could be. Engage with the tax authorities proactively. Your cross-border transaction volumes are significant. If they are, move away from a reactive position. Be proactive. Utilize the pre-filing consultation, but also look into the APAs, as we mentioned earlier, and lock in the compliance certainty for 3 to 5 years. That's the purpose of the APAs. The Chinese tax authorities are approachable, and they usually stay quite pragmatic. They also know it's very important to keep a taxpayer, but they will impose, of course, fines if you've been avoiding for a certain number of years. And they are more approachable than definitely some tax authorities in the West. So do not hesitate. This can also go through a third-party advisor. And avoid the aggressive legacy planning. The era of shifting profit through paper-heavy entities, multitude of offshore entities and tax haven, doesn't work anymore. Maybe it worked a little bit when I arrived 25 years ago, because also big data was not around the corner, but it is now. So the tax bureau is an established and sophisticated big data global enforcement leader, and they are training other tax authorities now. It's all about building a balance and genuine economic substance, right? The arm's length principle. Now, as we close the presentation, let's don't forget some maybe quick action you should be taking. Review the related party contracts, filing status to ensure that the intra-group transaction are documented with formal agreement, and of course, review this on an annual basis. Conduct the high-level FAR analysis and mapping exercise, right, for the function performs, the asset utilized, and the risk assumed to make sure they really match with the reality of what's happening in China, and you're not leaving the margin in or out of China without supporting evidence. And last but not least, of course, feel free to reach out to a TP advisor for sometimes a hedge check, which is a lot less expensive than what could be a drastic adjustment and penalties and late fines. So do not hesitate to initiate an inquiry early on. Okay, so this we're coming to the end of the presentation and to the Q&A. We have 5 minutes, but of course we can stay a little bit longer. If you feel that your question is a little bit too confidential or could be pointing to your company, just feel free to reach out to us through these, contact details that you see on screen now. So I believe we already have a question. Thanks from Andreas, asking, what if our TNMM approach leads to drastic reductions in cross-border transfer pricing and a sudden reduction in imported value? Is scrutiny by the customs likely? How to prepare, explain, defend? Because of course, the tax and the customs, when we say you need to determine the right price and the arm's length, this is the customs, this is the tax, pricing must be in the middle. But I'm not the expert. So, Andrea, I'm not sure if you understand the questions, if you could provide some details.
Sorry, Chris, could you please repeat the question?
Sure. So, as a trading company,
Yeah.
using the TNMM approach, this is leading to drastic reduction in the cross-border transfer pricing. So meaning the value of the goods have reduced, which is triggering maybe a higher, I would say, profit margin, right? So maybe making the tax bureau happier. But then this may link to scrutiny from the customs, because the customs, of course, the higher the imported value, the higher the tariff on the goods. So what would be the advice to the company to prepare, explain, or defend that the TNMM is actually dragging the price down and maybe lower import tariff.
Okay, I got it. I think that if you want to justify your transfer pricing position, you can always, just look at your, FAR analysis first. Means you need to explain from the functions, the risks, the assets, and from those perspective to see whether there's any kind of, change. Otherwise, you have to leverage whether there's any special reasons that could explain that. For example, if whether there's any big political issue or any economic issue happens, and with those kind of informations to explain whether such kind of change is reasonable or not. But of course, if we can have more details of the background, we can give out more, maybe better advice. So I think that I will welcome that that they can just send us this more background to us, and so that we can give better suggestion.
So Andrea, feel free to contact and get in touch with us. Another question from John. And our Chinese subsidiaries annual related party transaction are well below the RMB 200 million threshold for a local file, so for the mandatory documentation. Does this mean we are completely safe from a TP audit, or do we still need to prepare something?
No, that's not the conclusion. As I have introduced, actually, the threshold for local file is just a threshold for submission, and even the amount of related party transactions is below the threshold. The Chinese tax authority still have the right to ask for a local file, and especially if limited risk entity with a loss. For sure, the tax authority will ask it. And in this year, we saw a lot of cases. Some of our clients, their annual related party transactions is below the threshold. They still be asked to provide a local file. So in that case, I will just encourage the companies to prepare a local file in advance. If you think that prepare a very complicated, comprehensive local file is a little bit, just cost a little bit, then you can just consider to prepare even a simple one. Yeah, that could also help.
Thank you, Andrea. I have another question, one maybe a little bit complicated. And our regional HQ in Singapore charges our Shanghai entity a management service fee, so it's quite common, based on an allocation of the regional leadership team's salaries, as they frequently oversee China operation. Are these costs to the management fees safe from a TP perspective?
No, totally not. This is very, a common problem for most of the MNCs. The global headquarters always, allocate all kinds of fees. But based on China tax laws, first of all, the management fee is not allowed to be deducted before corporate income tax. And secondly, that for the service payment, Chinese entity must pass the benefit test. You have to prove that how the Chinese entity is benefit directly, economically, from the service provided. And they also need to justify that it's really specific service. It's not just shareholder activities, because for shareholder activities, those kind of costs is not allowed for deduction. And if the company could not pass the benefit test, the cost is not allowed.
Thank you, Andrea. I think we are now coming to the end of the webinar. It's already 4 p.m. So unless we have further questions, we'll close this webinar. I believe we do not have any further questions.
Okay. Then thanks all for your time.
Thank you, everyone, and wishing everyone an excellent end of the afternoon, and looking forward to welcome you to another tax session in the coming future. Thank you, Andrea, for your insightful presentation.
Thank you.